You are watching this because somewhere in the back of your cognitive architecture, you already believe one of these two investments is superior. That belief was not formed by forensic analysis. It was formed by social conditioning, by what your parents owned, by what your peer group brags about, by which financial influencer got to you first. This is a study in behavioral conditioning, and the first variable this audit will dismantle is not a number. It is the bias you walked in with. Every real estate versus index fund debate you have ever consumed was pre-concluded before it started. The analyst had already picked a winner. The math was reverse engineered to support it. This script does not operate that way. What follows is a forensic audit of two identical starting positions tracked over 20 years. Every cost included, every tax mechanic disclosed, every hour of labor priced, even the hours most analysts choose to forget. To eliminate all confounding variables, we construct a controlled comparison. Two subjects, identical financial profiles at the point of entry. Clark is 30, annual salary $55,000, liquid capital $50,000, no outstanding consumer debt. Jen is 30, annual salary $55,000, liquid capital $50,000, no outstanding consumer debt. Same city, same income bracket, same opportunity cost of capital at the point of deployment. The single independent variable is capital allocation. Clark deploys his $50,000 as a 20% down payment on a $250,000 residential rental property, a 3-bedroom unit in a stable suburban market. He secures a 30-year fixed mortgage at 7% interest. Monthly debt service $1,330. Rental income is set at market rate, $1,800 per month. Gross monthly spread $470. Jen takes the identical $50,000 and allocates it to a total stock market index fund. Broad diversification, no active management, no leverage. She establishes an automatic monthly contribution of $300 and does not intervene in the portfolio again. Note the psychological asymmetry before we proceed. Clark's investment is tangible, visible, and socially legible. He can drive past it. He can photograph it. He can explain it at a dinner table in one sentence and receive immediate social validation. Jen's investment is invisible, abstract, and socially unremarkable. When asked what she invests in, she says index funds. The conversation ends. This tangibility premium is not neutral. It is the mechanism by which real estate investors justify cost overruns, underestimate labor input, and hold emotionally compromised positions. Year 1. Clark is in what behavioral economists classify as the honeymoon phase of ownership. Rent deposits on schedule. He files for mortgage interest deduction and depreciation. This is a structurally significant tax advantage. Clark is legally writing off a fictional decline in a property that is in reality gaining value. Meanwhile, Jen's $50,000 has grown to approximately $55,000 by end of year 1, at the historical 10% annual return of the total U.S. equity market. She contributed $3,600 in automated deposits. Total portfolio value? Approximately $62,000. No calls, no paperwork, no keys. Over 3 years, Clark collects $64,800 in gross rent. His total mortgage payments are $47,880. Gross cash flow, $16,920. This is the number on the thumbnail. This is not the number in his checking account. After property taxes of $9,000, insurance of $4,500, a $1,200 water heater replacement, a $2,800 roof leak, and $2,400 in vacancy and relisting costs, Clark's total friction costs over 3 years are $19,900. His actual net cash flow for years 1 through 3 lands somewhere between $2,000 and $4,000. This does not include a single hour of Clark's labor. If we price that labor conservatively at $25 per hour, Clark has contributed an additional $3,000 to $5,000 in uncompensated effort. Jen's portfolio at end of year 3, approximately $76,000. Total capital deployed, $60,800. No labor input, no liability exposure, no single asset concentration risk. The leverage variable is what keeps real estate relevant. Clark used $50,000 to control a $250,000 asset, a 5-to-1 leverage ratio. After 3 years of market appreciation, the property's fair market value is approximately $270,000 to $280,000. Clark's equity position has grown to approximately $55,000 to $65,000, entirely through leveraged asset appreciation, independent of his cash flow performance. This is the primary structural advantage. However, systemic friction remains unmodeled. Vacancy rates average 1 month per year. Maintenance and repairs run at 1 to 2% of property value annually. Capital expenditures, roofs, HVACs, and water heaters are guaranteed future costs on finite replacement cycles. If Clark hires professional management, 8 to 10% of monthly gross rent is eliminated immediately. If he self-manages, he is simply converted a cash expense into an unpriced part-time job. A single eviction event can eliminate an entire calendar year of net cash flow.
By year 5, Clark's actual cash-on-cash return is running at 3 to 5%. This is a realistic output, but it creates cognitive dissonance between the projected return and the realized return. By year 7, Jen's portfolio has reached approximately $135,000 to $150,000. The inflection point in compound growth has arrived. The portfolio is generating more new wealth each year through compounding than her own capital deployment produces. By year 10, Clark's equity position is $170,000 to $184,000, but his wealth is geographically concentrated, illiquid, and operationally encumbered. Jen's portfolio at year 10 is $165,000 to $180,000. She holds fractional positions across thousands of companies, accessible for liquidation within 1 trading day. Liquidity is a risk-adjusted input. An asset you cannot sell without friction is not worth face value in a moment of capital need. The index fund strategy must face the same forensic treatment. Volatility is not abstract. In 2008 and 2020, drawdowns of 34 to 37% occurred. Behavioral data is unambiguous. Most retail investors do not hold through significant drawdowns. They liquidate at or near the trough, locking in losses. There is also no meaningful cash flow and no leverage. Jen deployed $50,000 to control $50,000. Additionally, there is no depreciation shield, a government-codified tax shelter available only to the real estate column. Year 20 terminal positions. Clark's property is worth $450,000 to $500,000 with the mortgage at payoff. Total net cash flow over 20 years is in the range of $50,000 to $90,000. Jen's portfolio has grown to approximately $420,000 to $460,000. The terminal positions are statistically equivalent. Both accumulated between $400,000 and $500,000 in net wealth, but the mechanism was different. The multiplier effect reveals the final gap. If Jen increases her monthly contribution by $200, her 20-year terminal portfolio jumps to $550,000 or $600,000. Scaling in index funds is a single arithmetic operation. In real estate, scaling requires acquiring a second property, doubling the operational footprint and risk. Real estate produces superior outcomes only when the rent-to-price ratio exceeds 0.8% monthly. The investor has the operational temperament for asset-intensive management, and they utilize depreciation and 1031 exchange mechanics. Index funds win when the investor has the behavioral architecture to hold through drawdowns and values time as a finite resource. Most investors do not fail at the math, they fail at the behavioral requirements. They panic sell, under-reserve for CAPEX, or overestimate their tolerance for illiquidity. The asset class does not determine the outcome, the operator does. Most investors fail not because of a lack of mathematical accessibility, but because of a lack of behavioral discipline.
They succumb to cognitive dissonance, underestimate unpriced labor, and ignore the systemic friction of illiquidity. If this level of forensic scrutiny is operationally useful to your capital allocation strategy, subscribe to Brutal Calculus now. This channel does not provide financial inspiration or entertainment. We provide the complete model, deconstructed through math and empirical data. Subscribe and enable notifications to ensure you never miss a forensic audit of the systems that dictate your net worth. Brutal Calculus, the complete model, every time.